We're going to be talking now about diversification. So let's share the screen and get started. Okay, so what is diversification? First of all, diversification is expanding the types of products and services that you offer. So 4 steps when crafting a diversification strategy is being looked at. Step 1, you're going to look at new industries to enter and decide on how you're going to enter that industry. Step 2, you're going to pursue opportunities to leverage cross-business value chain relationships and strategic fit into a competitive advantage. Step 3, you're going to establish the investment priorities and steering corporate resources into the most attractive business units. And step 4, initiating actions to boost the combined performance of the cooperation's collection of businesses. So when does diversification become a consideration? Diversifying becomes feasible or considered when, 1, it can expand into businesses whose technologies and products complement its present business. So you don't want to enter the food market when you manufacture steel. You want it to be close, okay? Number 2, the resources and capabilities that you have can be used as a valuable competitive asset in other businesses. The cost can be reduced by cross-business sharing or transfer of resources and capabilities. And 4, transferring a strong brand name to the products of other businesses that will help drive sales and profits to those businesses from the very beginning because you have a very strong brand. So there are 3 tests to see if diversification will add a long-term value to the shareholders. So 1 is the industry attractiveness test. So if that industry is big enough and very attractive and you know that you could enter it and be profitable very quickly, it's an advantage to your shareholders. If the cost of entry into that industry, into that new business is low, then again, it's not going to cost that much. It will be an advantage to the shareholders. And 3rd, the better off test. Will the company be better off because of this diversification? So first of all, we need to evaluate the potential for synergy between what we already do and this new product, new service, new industry, whatever you're entering in. So 2 examples. Firm A purchases Firm B in another industry. A and B's profits are no greater than what each firm could have earned on its own. So if 1 + 1 = 2, then it makes no difference whether they're 2 companies or if they're 1 company. So there is no synergy. But in the second scenario, Firm A purchases Firm C in another industry. A and C's profits are greater now because you can take advantage of the knowledge that you have or the products that you have or the materials or the, it could be the raw materials, it could be being able to buy and transport in bigger bulk. But whatever the scenario, 1 + 1 = 3 or more. So now you're going to make a better profit, a higher profit based on the union of those 2 businesses. That's when it makes sense to diversify. So sometimes you diversify into new businesses. So you acquire an existing business. You do an internal new venture startup. or you do a joint venture with another company. So 3 different ways of diversifying into those new businesses. The advantages of acquiring an existing business is that you've got quick entry into an industry, barriers to entry are avoided, access to complementary resources and capabilities are quick. Disadvantages are that the cost of acquisition could cause long-term issues. That initial cost of purchasing, let's say a bargain or a struggling firm, could have some unforeseen problems. You could underestimate the cost for integrating the 2 companies, or overestimate the acquisition's potential to add value. Entering a new line of business through internal development, in other words, a new venture, they call it intrapreneurship or think tanks or skunk works. There's different terms that you're creating. You've got a protected area where they're creating something new. The advantages are that it avoids pitfalls and uncertainty of buying something, of acquiring another business. You can enter into newer emerging industries where there is no candidate available to purchase. The disadvantages are that you must overcome the industry entry barriers yourself. It could require long-term investment, expensive investments, and it could fail. So there are those disadvantages. So when do you engage in internal development? Well, you have the availability of in-house skills and resources. You have ample time to develop and launch a business. The cost of acquisition is too high than compared to building it in-house. The added capacity will not affect supply and demand. There's low resistance of incumbent firms to market entry. No head-to-head competition. So if you're facing any of these 6 or a combination of those 6, it may make sense for you to start up something internally without purchasing someone else's work. So when do you do a joint venture where you and another company join together and work together as equal partners? If the opportunity is too complex, uneconomical, or risky for one company to pursue alone? Or does the opportunity require a broader range of competencies and know-how than you have, but the other company has something you need, you have something they need? So then the 2 companies combined have greater competencies. Or will the opportunity involve operations in a country that requires foreign firms to have local minority or majority ownership? So choosing a mode of market entry. The question of critical resources and capabilities. Does the firm have the resources and capabilities for internal development? When it comes to entry barriers, are there entry barriers that you can overcome, or do you need an outside partner to overcome that? The question of speed. Is speed of the essence in the firm's chances for successful entry? And the question of comparative cost, which is the least costly mode of entry given your objectives. So now we're going to talk about diversification based on whether you have related or unrelated businesses. So you can diversify with a related business, unrelated, or a combination. So related businesses have competitively valuable cross-business value chain and resource matchup. So you already know that industry because they're related. Unrelated, dissimilar value chains, different resource requirements, no competitively important cross-business relationship. And then you have the strategic fit opportunity. So you're transferring specialized expertise, you're transferring technological know-how and other resources and capabilities from your business to another. You're sharing costs between businesses by combining into a single operation. You're exploiting common use of well-known brand name. You're sharing any other resources that make sense outside of brands. So here's two businesses. You've got the support activities, and then you have a share of transfer valuable specialized resources and capabilities at one or more point along the value chain of business A and B. So where are you using each other's supporting activities? Is it in the supply chain activity? Is it the technology or operations? Is it sales and marketing knowledge? Is it distribution? Is it customer service? You're looking for one or more of these points where you're going to share, and one has either you need to join forces to make it happen because of the risk, or let's say that firm B has better technology than firm A, so they have the technology advantage. Firm A has the sales and marketing, and maybe they have the brand recognition. So one company has a better item, a better value chain activity than the other. And if they combine forces, they can be a powerhouse against other competitors. So some areas where you can see potential for that cross-business fit: R&D, research and development and technology activities that you can share, supply chain activities, manufacturing related activities, distribution related, customer service activities, or sales and marketing activities. Each of these 6 can have a huge value advantage if you study it well and you match up with a company that can complement your own. So here are 4 different scenarios that use economies of scope to convert strategic fit into a competitive advantage. So maybe you're transferring specialized and generalized skills and knowledge. Maybe you're combining related value chain activities so that you achieve lower costs. Maybe you're leveraging the brand name and other differentiation resources, or you're using cross-business collaboration and knowledge sharing, which will also give you that advantage. So what is the difference between economies of scope and economies of scale? Economies of scope are cost reductions that flow from cross-business resources, from sharing those in the activities of multiple businesses of a firm. So economies of scope, you have cost reductions because you're sharing activities. Economies of scale is when the unit costs can be reduced because you're producing a larger volume. Okay? So you could experience one or the other, or you could experience both in expanding internationally, whichever way you go. Okay. So diversification into unrelated businesses. When you're evaluating the acquisition of a new business, or you're divesting an existing business, what are you concerned about? 3 questions. Can it meet corporate targets for profitability and return on investment? Is it in an industry with attractive profit and growth potential? And is it big enough to contribute significantly to the parent firm's bottom line? Remember, if you join forces and you're either at a less advantage or an equal advantage where you didn't gain anything, there's no point in doing the merger. Okay, so using an unrelated diversification strategy to pursue value. Let's say that there is astute corporate parenting by management, so you can really guide that new company. There's cross-business allocation of financial resources. Maybe you don't need a whole other plant. You can go to 2 shifts or 3 shifts in one plant. You have huge savings. Acquiring and restructuring undervalued companies. So you may have the knowledge to really bring a company up where the previous owners didn't have that skill set. So the path to greater shareholder value through unrelated diversification. 3 tests. The attractiveness test. So diversify into businesses that can produce consistently good earnings and returns on investment. Or the cost of entry test. You can negotiate favorable acquisition prices. Or the better off test. Provide managerial oversight and resource sharing, financial resource allocation, and portfolio management. And then you restructure underperforming businesses. The dual drawbacks of unrelated diversification. The demand of managerial requirements of the parent company and limited competitive advantage potential. Okay. So if you are facing either of those and they're not giving you good outlooks for that diversification, don't do it. You're better off not going into that area. Here are some poor rationales for unrelated diversification. So this is, for example, when Pepsi bought Pizza Hut. Okay, they went into unrelated firm. Restaurant versus selling beverages is significantly different, and it hurt them financially so much that they eventually created a 3rd company, and they put all the restaurants they bought under that company that's managed completely separate from Pepsi-Cola. Okay, so 4 poor rationales. You're seeking to reduce business investment risk. Anytime you're buying something that's different, there is an investment risk. Pursuing rapid or continuous growth for growth's sake only. You have to have a good reason to do it. You seek stabilization to avoid cyclical swings in businesses. So you want to buy this business because you think it's going to help you to have a high profit margin year round, or pursuing personal managerial motives. When you're related versus unrelated business, like a portfolio combination, you have a dominant business enterprise. There's narrowly diversified firms, or broadly diversified firms, or multi-business enterprises. So, for example, Procter & Gamble and Unilever are manufacturers of home products, from kitchen to cleaning to hygiene to all sorts of home-based products. They use a multi-business enterprise where every one of their brands is an independent unit, financially profit center, and they have an overarching strategy that comes from Procter & Gamble. But every product line, every brand is kept as a separate unit. So that's a multi-business. So dominant business enterprises, they have a major core firm that accounts for 50 to 80% of total revenues, and then a collection of small related or unrelated firms that account for the remainder. A narrowly diversified firm comprised of a few related or unrelated businesses. Broadly diversified, they have a wide range of collections of related businesses and unrelated businesses. And multi-business enterprise, they have a portfolio consisting of several unrelated groups of related businesses. So your diversified strategy, okay? When a company is diversified, you want to look at the attractiveness of the industries, the strength of each of its business units, the cross-business strategic fit from one product line to the other, new strategic moves, allocation of resources, and fit of the firm's resources. So 3 alternatives to pursuing diversification. You can diversify into related businesses, into unrelated businesses, and into both. So step 1, you're going to evaluate the industry attractiveness. So how attractive are the industries in which the firm has business operations? So each of the firms you're considering in that industry, does it present a good market? Which industries are more attractive versus least attractive? And how appealing is the whole group of industries? So calculating the industry attractiveness, how well do the industry's value chain and resource requirements match up with the value chain activities of other industries? Or the question of resource requirements, do the resource requirements for an industry match those of the parent? Are they within the company's reach? Okay, 2 key questions. And then if you're going to evaluate the industry attractiveness, you need to decide on the appropriate weights for the industry attractiveness measures. You want to gain sufficient knowledge of industry to assign accurate and objective ratings, and then whether to use different weights for different business units based on how significant they are in that industry from business to business. So here's an example, 3 industry attractiveness assessments. Each industry you're looking at industry attractiveness measures, okay? So they have used a weighted score, and if you just look at the top line here, market size and projected growth rate. So the importance overall is 0.1. They gave an attractiveness rating from the scale very unattractive to very attractive. We got an 8. So 0.10 times 8 is 0.8. So that's the weighted score. Industry B has an attractiveness rating of 3. So 0.1 times 3 is 0.3. And industry 5, industry C, attractiveness rating of 5, weighted score of 0.5. So you go through each one of these, and in this scenario, they decided that the importance scale would remain the same for each industry. And then at the end, you add up the weighted scores, and which one are you going to choose? You're going to choose the highest score, so industry A is the most attractive, and that's where you would want to invest. So this type of rating is done for industry attractiveness. It's done for any time you're looking at attributes of a product, of a service, of a new invention, of just about anything, any unit, you can decide what are the criteria, set rates, and then analyze. It's very, very effective. So step 2, evaluating the business unit competitive strength. So what is their relative market share? What is the cost relative to their competitors' cost? What is the ability to match or beat rivals? The brand image or reputation? Other completely competitively valuable resources and capabilities, partnerships and alliances, benefits from a strategic fit, bargaining level with other key suppliers or customers, and the profitability relative to the competitors. So again, you can go through and calculate competitive strength measures, okay, to the business units. Okay, so this is business A in industry A. This is business B in industry B, business C in industry C. Okay. You also can plot these into this industry attractiveness competitive strengths matrix and try to decide what are the, if it's a star, then it has a strong competitive strength and market position and a high industry attractiveness. Business C in industry C, you can see that the dollar value, the business volume is bigger based on the size of the circles, and it's a cash cow, so it's going to bring in quite a bit of money without large expenditures. And then industry B in business B in industry B, weak competitive strength, low attractiveness. You really would not want to hold on to that or invest in that. Step 3, determining the competitive value of strategic fit in diversified companies. So what is the degree of strategic fit? And what is the real test of a diversification strategy? It's the degree of competitive value that it can be generated from the strategic fit. So here, for example, the value chain activities, you've got purchases from suppliers, technology, operations, sales and marketing, distribution, services. And you've got 5 businesses. So the lines are indicating different things. So these lines, like this, diagonal, opportunity to combine purchasing activities to gain more leverage with suppliers and realize sales. Okay, so business D and business A have those economies of purchase. But if you look at the line, the red dotted line around it, it says there's no strategic fit opportunities. Okay, so businesses B and C kind of go together. Business D is not included in those, so business A and D would have the closest strategic fit opportunity. Okay, when it comes to technology, opportunity to share technology, transfer technical skills, combine R and D. So again, these companies don't have a strategic fit, but business A and E do have a strategic fit. When it comes to operations, collaboration to create new competitive capabilities, you'll see that business B doesn't fit, but the others do. When it comes to sales and marketing, the opportunity to combine sales and marketing activities, use common distribution channels, leverage the use of common brand name and or combine after-sales service activities. You'll notice that A and E are separate, but these three have a strategic fit, okay, or an opportunity. Then you've got distribution and service. And if you go across, business A was not included as much. Business B was included in all but one. Business C is in all of them. Business D, all but one. Business E in two. So the business C would be the most attractive to adopt. Step 4 is non-financial resource fit. So does the firm have or can it develop the specific resources and capabilities needed to be successful in each of the businesses? Are the firm's resources being stretched too thinly by the resource requirements of one or more of its businesses? Step 5, ranking business units and assigning a priority for resource allocation. So you're going to rank things like sales growth, profit growth, contribution to company earnings, return on capital invested in the business, and cash flow. And then you're going to steer resources to business units with the brightest profit and growth prospects and a solid fit. Okay, I'm going to skip that. Step 6. Crafting new strategic moves to improve overall corporate performance. So you can stick with the existing business lineup. You can broaden the diversification base with new acquisitions. You can divest and retrench to a narrower diversification base, or you can restructure through divestitures and acquisitions. So the 4 main strategic alternatives after a company diversifies is, number 1, broaden that diversification, so add more businesses that complement and strengthen, but can be in other industries. Divest some businesses and retrench to a narrower diversification, so you can sell off, you can spin off companies or industries that are products that are not as attractive. You can restructure the company's business lineup through either acquiring businesses or divesting to create a whole new face of the company's lineup, or you can pursue multinational diversification. And that's the end of this chapter. I hope it has been a useful discussion, and look forward to talking to you again next week.